This is the question we're going to be solving. I'm going to read it on the I'm going to put it on the screen. It's on adjusted present value. Basically, the class just continued. Okay, so say Baba Limited, an unlisted company based in Nigeria, has been manufacturing electrical parts used in mobility vehicles for people with disabilities and the elderly for many years. These parts are exported to various manufacturers worldwide, but at present there are no local manufacturers of mobility vehicles in Nigeria. Retailers in Nigeria normally import these mobility vehicles and sell them at an average price of $4,000 each. Say Baba wants to manufacture these mobility vehicles locally and believes that it can sell these vehicles of an equivalent quality locally at a discount of 37.5% to the current retail price. The current retail price that people are selling is $4,000. Now, say Baba wants to now start selling their own, right? At what? $4,000 times 100% minus 37.5%, right? They want to discount it. Nice investment idea. Although this is a completely new venture for Say Baba Limited, it will, in addition to the company's core business, bring this in. Say Baba Limited directors expect to develop the project for a period of 4 years and then sells it for 16 million disposal, right, to a private equity firm. Nigeria's government has been positive about the venture and has offered Say Baba Limited a subsidized loan of up to 80% of the investment funds required. Can you already relate to what we learned in the last class? You can see subsidy. That one alone has already given you the hint that it is what? APV. From the beginning, you know that is an investment appraisal question. Let me say at this point that when you see this kind of question, because this question is long, you read the requirements first because you are under exam condition. That will help you to know if you can solve the question. At a rate of 200 basis points below Say Baba borrowing rate. Currently, Say Baba Limited can borrow at 300 basis points above the 5-year government debt yield rate. That debt yield rate is a risk-free rate. As we are reading the question, you see the risk-free rate. They'll give you a particular risk-free rate, and they say that currently Say Baba is borrowing at 300 basis points above. So you add 3% to it. That's what their current rate, the normal loan rate. Now, what is the subsidized loan rate? Right? You're already gathering your details. Your subsidized loan rate is what? 200 basis points below. So you need to do what? Minus 2% from whatever your current rate is. Does that make sense? It makes sense. Then they said a feasibility study commissioned by the directors at a cost of 250,000 naira has produced the following information. That feasibility study is a what? An irrelevant cost. Is a sunk cost because it has been incurred in the past. They can conduct the feasibility study and still not continue with the project. So this $250,000 that they gave you is just to trick you, but you need to know that it's an irrelevant cost. Initial cost of acquiring suitable premises will be 11 million. Premises, 11 million. Plant and machinery used in the manufacture will cost $3 million. Acquiring the premises and installing the machinery is a quick process, and manufacturing can commence almost immediately. You see, they are giving you that is year zero's what? Year zero's outflow. They're telling that 11 million plus 3 million equals 14 million is what? Initial outlay. That's it. Then they said it is expected, information 2, that the first year 1,300 units of this mobility vehicle will be manufactured and sold. They are giving you details already. Unit sales will grow by 40% in each year. In year 1, it's going to be 1,300 units. In year 2, it's what? 1,300 times 1.4. It will grow by 40%. Year 2 will grow by 40%. Okay, so before falling to an annual growth rate of 5% for the final year. So in year 4, it will grow by 5% only, because they've told you that this project is for what? 4 years only, right? After the first year, the selling price per unit is expected to increase by 3% per year. You now ask yourself, what is the selling price of the first year? They've given you in the first paragraph. So don't be confused by the plenty information. Just be reading and be understanding the question. They've given you in the beginning that this year 1 selling price, 4,000 multiplied by a discount, right? So now they've told you here that the price will increase by 3% per year. So that 3% increase, you won't do it in year 2 to year 4. That makes sense. So information 3, in the first year, it is estimated that the total direct material, labor, and variable overhead cost will be $1,200 per unit produced. Okay, after the first year, the direct cost are expected to increase by an annual inflation rate of 8%. Then they said annual fixed overhead cost would be 2.5 million, of which 60% are centrally allocated overhead. When you tell you that overhead or fixed costs are centrally allocated, it means that it is not everything that is relevant, right? Centrally allocated means that whether the investment holds or not, we will incur 60% of this fixed cost. So it means it's only 40% that is relevant. That's what it means. So it's only 40% of 2.5 million that you will use as your fixed cost that will be relevant in this investment appraisal. Then inside, the fixed overhead cost will increase by 5% per year after the first year. So straightforward. Now they said Sebaba Limited will need to make working capital available. You see, in your first year, in year 0, at the start of the project, you need to make 14 million available. Now they're telling you again that it will make working capital available, or 15% of anticipated sales revenue for the beginning of the year, right? At the beginning of each year, the working capital is expected to be released at the end of the 4th year when the project is sold, which is a normal assumption of working capital. Remember that in our previous classes. Sebaba Limited's tax rate is 25% per year on taxable profit. Tax is payable in the same year as when profit is earned. Can you see? Tax allowable depreciation, that's like capital allowance, is available on the plant and machinery on a straight line basis. So once you see tax allowable depreciation, it means that there's going to be what? Tax savings. There's going to be tax shield, right? Then they said it is anticipated that the value attributable to the plant and machinery after 4 years is $400,000 of the price at which the project is sold. They told you in the beginning that the project will be sold, to be disposed at 16 million, right? Now they are telling you that out of this 16 million, $400,000 is the value attributable to plant and machinery. That's the scrap value. That scrap value, that $400,000, is only relevant when you are trying to calculate the capital allowance. Don't go and put $400,000 again in addition to this 16 million when you are disposing in your when you are trying to calculate your base case MPV. Okay, it's only relevant when you want to calculate your capital allowance, your tax savings on capital allowance. Okay, no tax allowable depreciation is available on premises. That means tax allowable depreciation is available on plant and machinery, but not premises. Now, another paragraph. Sebaba Limited uses 8% as its discount rate for new projects, but feels that this rate may not be appropriate for the new type of investment. It intends to raise the full amount of funds through debt finance and take advantage of the government offer for a subsidized loan. You understand that paragraph? Issue costs are 4% of the gross finance required. See what I explained in the previous class, right? It means that this money they raised, this money that they raised is the required amount. Now you have your total funds required and you have your total funds raised. What you raised, the total funds they raised is 100%, right? What you require will be 100% minus your issue cost rate, which is 4%. Do you understand? So to get your issue cost, it's going to be what? You said issue cost is 4%. It will be 4% over 96%, right? Multiplied by the total funds required, which is 14 million plus working capital. We'll go into that when we are calculating present value of issue cost. That is where you need that, right? So they said, although no other company produces mobility vehicles in Nigeria, Tinubu PLC, a listed company, produces electrical powered vehicles using similar technology to that required for the mobility vehicles. They're just telling you about the proxy. You have branched into the proxy information. And you already know why you need the proxy information, because you are going into a new business. There's a particular cost of equity, KU, that you use to discount the project. You have to go and get it from a company doing something similar, right? So they are saying that this Tinubu PLC is a listed company that uses a similar technology. So that is an assumption also, right? They said Tinubu PLC's cost of equity is estimated to be 14%, and it pays tax at 28%. Tinubu PLC has 15 million shares in issue, trading at $2.53, and 40 million bonds, trading at $94.88 per $100. The 5-year government debt yield is currently estimated at 4.5%. That's the risk-free rate. This X I was telling you, look at 4.5%. That's the risk-free rate, right? You can see at what paragraph you got it. So they just scatter the information around, but your formula will guide you. And they said the market risk premium is 4%. Required: evaluate on financial grounds whether Sebaba Limited should proceed with the project, 17 marks. B, discuss the appropriateness of the evaluation method used and explain any assumptions made in part A above, 8 marks. So this question is 25 marks. Now, evaluate on financial ground whether Sebaba Limited should proceed with the project. What will make you to proceed with the project if the MPV or if the APV, not MPV, the APV is positive, right? So you just write your words. A, evaluation. Don't go and start writing the question. Evaluate whether, evaluation of project what? Mobility vehicle. You have already written Sebaba Limited on top. Project mobility vehicle, right? Using what? Adjusted present value, right? What is the formula? When you have your formula, it has helped you to write out all your variables so you know what to look out for. Does that make sense? So you say what? Base case MPV, because that's what you're supposed to start with. Base case MPV. You put your, it's not naira, it's dollars. The next thing is what? Your present value of financing effect. You don't have to write down, or you can write it if you like. Present value of financing effect. Under that, you're going to have what? Your present value of issue costs, your present value of tax shield on interest. The next thing is your present value of subsidized loan. Can you see? So you write your base case MPV. You go and calculate it. To go and calculate your base case MPV, that's where you put yourself inside workings 1. Then you now flip your page. Workings 1. You see that you are giving your work a structure like this. Because where will you start from in this question? Right? So to get your base case MPV is your normal MPV. Now, remember our normal MPV format. The only difference is what? You are discounting. When you get to the point of you discounting, to get your present value, you discount with KO. KO. And we said in our last class that KO means cost of equity of an ungeared company. Meaning, strip out debt elements. Strip out any debt elements in your cost of equity. That's what it means. So, no explanations in this class. Year 0, year 1, year 2, year 3, year 4. Will it extend to year 5? No, it will not extend to year 5 because it's only tax that makes your project to extend to year 5 whenever tax is 1 year in arrear. So since it's not 1 year in arrear, it's not going to extend to year 5, right? The first thing to start with is your sales. You start with your sales. You now go and get your sales because they still twisted you in that sales. You now change your sales to what? Workings 2. You now flip your page again and say workings 2 sales. Now, I'm not going to be showing all those workings because I don't have that space. I'll just be using my calculator. Where is my calculator? So they said it is expected that in the first year, 1,300 units will be manufactured and sold. Right? So in the first year, 1,300 units is manufactured and sold. At what price? So this is quantity. At what price would they sell it? They said it in the beginning of the question that they are selling at $4,000, but they intend to sell under this whole project at a discount of 37.5. So that's 4,000 times 1 minus 0.375. That's they are selling at 2,500 at a discounted price. Okay, they're selling at 2,500. Now this is year one. By year two, what would the quantity be? Because it's quantity and price, it's quantity multiplied by price that will give you the sales value that you will now move here. This one is just in our workings. So by year two, they said unit sales will grow by 40%. So this one will grow by 40%. That's 13. That's 13 multiplied by 1.4. That's 1,820. Then 1,820 multiplied by 1.4, because in year 3 it will also grow. That's 2548. Then by year 4, they said is that by year 4, before falling to an annual growth of 5% in the final year. Year 4 is the final year. So this 2548, you won't raise it by 40%, you will raise it by 5%. That is multiplied by 1.05, right? And that will give you 2675. What are the corresponding prices per unit for year 2, year 3, year 4? You check the question, because you read the question, so you know that they said it somewhere that price will be what? After the first year, the selling price per unit is expected to increase by 3% per year. 25 times 1.03. You have 2575, 2652, 2732. 13 times 25. That will give us $3,250,000, right? So year one is what? $3,250,000, right? So just abbreviate your $1,000 here, year one, right? So you already have your sales value. Now the next thing for you to go to is your direct materials, right? Estimated that the total direct material, labor, and variable, they put everything together. So that's your direct material, labor, and variable. Let's just call that your variable cost, right? Since we also have fixed cost, that will be in your workings 2. Okay, your base case MPV set is workings 1, so your sales is workings 2, while your variable cost is workings 3. Yes, workings 1, your workings 2 is in your own book. In the next page, the variable cost, that's what we're going into now. So they said in the first year, it is estimated that the total direct material, labor, and variable overhead will cost 1,200 per unit produced. We've already calculated that in the first year, the units produced is 1,300 units. In year 2, it is 1,820 units. In year 3, it's 2,545 units, like that. But they are telling you now that the price per unit for variable cost is 1,200 per unit. So your workings 3, you just write your variable cost. Fast to price per unit 1,200, number of units 1,300 units, 1,820 units, 2,545 units, 2,675 units. Then the price per unit 1,200 in year 1. In year 2, they said after the first year, direct cost is expected to increase by an annual inflation rate of 8%. So all you need to do is say 1 to multiply by 8%, right? Multiply by 1.08, so you have 1,290. Let's use calculator. 1.08 multiplied by 12, you have 1,296. Multiplied by 1.08, you have, then multiply by 1.08, you have 1512. So you multiply this, and then you put your values here. So after you've gotten your variable cost, what you need to do is to get your fixed cost, right? Your fixed cost, you need to put that in workings. What did they say about fixed cost? They said annual fixed overhead cost. Okay, you need to put that in workings. So that will be your workings 4, right? Annual fixed overhead cost will be 2.5 million, of which 60% are centrally allocated overheads. Okay, so what you need to just take 40% in your workings 4. You just say 40% times $2.5 million, right? So let's do that. 0.4 times 2.5, that's 1 million. So it's only 1 million that is relevant here. So year 1, you have what? 1 million. No, that 1 million, you write it as 1,000 because you abbreviated. Okay, so that's a fixed cost. What did they say about fixed? They said fixed overhead cost will increase by 5% per year after the first year. Multiply this one by 1.05, that is, you are increasing by 5%. That is times 1.05. You have 1050, 1103, 1158, right? So that is your fixed cost. After that, what next? Is there any other cost? No. You cast. You are trying to get your operating profit, right? Your cash operating profit before tax, right? Which is logical. This is what we do normally in accounting. Cash operating profit before tax. So when you do this, so you get your cash operating profit before tax. Now that you've gotten that, the next thing for you to do is to apply tax, okay? And I said it in the second class on investment appraisal that your tax can be in form of an outflow, which is your normal 30%, and your tax can also be in form of your inflow, which is what? Tax savings, right? So you're going to do the two of that. You charge your normal tax first before you do tax savings. So that's tax at how many percent? What did they say? They said Save Aba's limited tax rate is 25%. So it's not the usual 30%. So you do your tax at 25%. And they said tax is payable what? In the same year as when profit is earned. So don't do all those tax. One will be applied in year 2. Tax year 2 will be applied in year 3. Just apply it in the year that they are incurred. So 25% of 690. 0.25 times 690. That gives us 173. 319, 522, 526. So that is your tax outflow. Then the next thing to get is your tax savings. There will definitely be tax savings. Now this one is not the tax savings or tax shield on interest too. This is tax savings that has to do with capital allowance. Can you guys see? Hope this thing is still showing. Actually, we will not move up now. Okay, after this we're going to move up. So this one now is tax savings, right? You go to what? Your workings. You have to go and do that in your working 5. Okay? So let's go and do it in working 5. Let me just claim on top of here. To get your tax savings on capital allowance, right? Tax savings is on something. It is on capital allowance. So you first of all get your capital allowance, right? And that capital allowance is like depreciation. So whenever I say tax allowable depreciation, that's what it means. It means capital allowance. Okay? So they said tax allowable depreciation is available on the plant and machinery on a straight line basis. Ask yourself, how much is plant and machinery? The asset upon which I want to calculate this capital allowance, how much is it? Plant and machinery is how much? They said it at the beginning that plant and machinery will cost 3 million, right? It will cost 3 million. 3 million. Now they said it is anticipated that the value attributed to the plant and machinery after 4 years is 400,000. So you need to take out that residual 400,000, right? So that it will reduce that plant and machinery value to be what? 2,600,000, right? Because you can't calculate depreciation on something you're disposing. Does it make sense? So if you are disposing 400,000 at the end of year 4, you can't depreciate the 400,000 now. You can't. So it's only this 2.6 million that was depreciated, because at the end of year 4, the value an asset is still worth 400,000 naira. So what depreciated from it is what? 2,600. So you need to spread it over 4 years, right? So you spread it over 4 years. So 2,600,000 divided by 4 years. That will give you 650,000. So this 650,000 is your capital allowance, right? Yearly. Capital allowance yearly. This capital allowance is tax deductible. So because it's tax deductible, because it is something that is recognized, you must calculate tax savings on it. That's where tax savings come from, which I actually explained in previous classes. So tax savings on this 650,000 naira is what? 0.25, which is your tax rate, multiplied by 650,000, right? In year 1, in year 2, in year 3, and in year 4. So 0.25 times 650,000, that will give us 162,500. So every year you have 162,500 as your tax savings. Is that 162,500 that you bring in? So if you want to write 162,500 here, you write it as 163. Abi? It makes sense because you can't be writing 162.5. Just round up. So this one is not an outflow. Tax savings is an inflow effect. It's an inflow effect. So you have 163, 163, 163, and 163. Does it make sense? After this, you can now have your cash operating profit after tax, co-part, right? So you cast it. Can you guys see that? You have your cash operating profit after tax, which is 680, 1121, 1728, and 1742, right? Now when you have your cash operating profit after tax, this is like net inflows, right? Net inflows. Now you want to get your outflows. Those things are usually coming in year 0, because you're trying to get your net present value. You want to know if the project is profitable, so you have to set inflows and outflows. This is what will come in. We'll sell, but to sell we have to incur this cost, right? We'll pay tax, but we'll save something on tax. So this is our net savings, our net inflow. Now let's go and get our net outflow. So where should we continue? Should we continue here? We should clean up this place. Okay, let me just clean up this formula. Since we already know this formula, let me just clean up this formula, because I don't want to clean this base case MPV. Sorry, we don't have enough, but even if we are, there's no amount of board that will remove cleaning. Even if you're in class, they will clean it. It's your notes and your question that you have to be referring to, right? So since you have your cash operating profit after tax, what you need to now do is that's when you bring your initial investment in, right? Initial investments, year 0, year 1, year 2, year 3, year 4, year 5. Now what is your initial investment? Remember that 11 million that they said you will use for premises. I remember the plant and machinery of 3 million, right? So that's 11 million plus 3 million. That's 14 million. But then you need working capital. Remember, you need working capital. So your initial investment is what? 14 million. So write that as 14,000. Remember that it is abbreviated 000. So write that as 14,000. Then you bring in your working capital. What did they say about working capital? They said Sebaba Limited will need to make working capital available of 15% of the anticipated sales revenue for the year at the beginning of each year. The working capital is expected to be released at the end of the 4th year. So write your working capital and quickly go and do what? Workings 6, because you have to calculate. They didn't give you these things directly. So you go to your working 6, working capital in year 1, in year 2, in year 3, in year 4. You say working capital was 15% of sales, right? I know you bring in your working capital in year 0. Don't forget our assumptions that you bring in your working capital in year 0. So what is 15% of sales, right? A working capital you are going to use in year 1. Working capital you are going to use in year 1. You bring it in year 0. Remember our assumptions in the introductory class. So your sales is what? 3,250 in year 1. So you say what is the working capital you need in that year 1? Is what? 0.15. 0.15, that's 15%, times 3,250,000. And that will give you 487.5. So you just summarize to what? Or abbreviate or approximate to 488. So you bring in 488 in year 0. Can you see that? This 488 you brought in year 0 is for year 1. What you need in year 2, you bring it in year 1. What you need in year 3, you bring it in year 2. What you need in year 4, you bring it in year 3. And then you must recoup at the end of every year, right? So here you are just introducing your working capital. You will still what? You will still recoup it. Like this one that you bring in for year 1, you must recoup it by the end of year 1. That is, you gain it back. I've explained that assumptions in our previous class. So now this for year 2, you have 4687. 15% of 4687.15 times 4687. That gives you 703, right? So you have 703 in year 1. It's for year 2. It's for year 2 sales. But you bring it in year 1. It's at the end of year 2 that you recoup it. Does it make sense? So the working capital you need for year 3 is what? 0.15 times 6757. That's 1014. Okay? You bring it in year 2. It's something you need for year 3. You bring it in year 2. You spend it in year 2. That's what it means. 1014. And you will gain it back when? In year 3. At the end of year 3. That's an assumption. That's the assumption in investment appraisal. Working capital. Now for year 4 working capital, you say 0.15 multiplied by sales of year 4. 7308. That's 1096. It must be brought in year 3. 1096. For you to recoup it by the end of year. Listen, that 1096. So when you add up this, whatever you get, the movement, that's what you take here. We don't want these workings. It's the movement you are bringing here. Okay, I explained the assumption. I think where you should check is you should check class 1, the first class I've done months ago on investment appraisal. That's where you understand this thing. But even with this explanation too, you still get it. So here you have what? 488, 215, 3182, 1096. Right? So when you add, this is what you have. So if at the beginning of year 1 you brought in 488, it means what you actually did. This is what we call actual cash movement of working capital. You actually spent 488, right? But in year 2 you needed this 703, right? Because you have recouped 488, you won't need to now spend the whole 703. What you actually spent was 215, which is the balance. Does it make sense? The assumption is that when you incur working capital, which is short-term fund, your sales, when you sell, you should be able to make it back. So you won't spend as much as you actually spent in the previous year. And at the end of the year, you should recoup it back. If you add these 4 together, you get a negative of this, right? That's one way to know you are correct. So is this one you take here? Working capital. You take your 488 to year 0. Can you see? 215 year 1. 311 year 2. 82 in year 3. 1096 in year 4. We don't need year 5. Our tax did not extend, right? So we can clean up this one. I hope it's not looking too clumsy. So now that you've gotten your working capital, the next thing to put is your what? Disposal. Sometimes there's no disposal, but here there's disposal. And they said in the question that for a period of 4 years and then sell it for 16 million to a private equity firm. So don't sell it at 16 million at the end of year 4. So it's an inflow. That would be what? 16,000. You know, you won't write million because you have abbreviated to thousands. Okay, so that's what we have, right? I think that's all. So after you dispose, that's the end of the project now. Then you get your what? Net cash flows, right? When you get your net cash flows, you will discount. You will discount at what rate? At KO. We'll go and get that KO. That's why they gave you proxy information that Tinubu PLC, something, they are doing a similar project, right? Then when you discount those net cash flows, that's when you get your what? Present values. When you add those present values together, that's how you get your what? NPV. Not just NPV, a base case NPV. So let's get our net cash flows. Okay, net cash flows, what you used to do is you start from here. So for year 0, your net cash flow will be what? 14,488. For year 1, you know, if you start from down here, 680 minus 215, you have 465. For year 2, you have 810. For year 3, you have 1646. For year 4, you have 18838. Now you discount at KO, right? You discount. Now to get this discount rate, right? Because they said something in the question. They said Say Baba Limited uses 8% as its discount rate for new projects. This is a new project. They use 8%, but it feels that this rate might not be appropriate. It can be appropriate now because there's a new business risk. You can't use existing discount factor. You know, when there's a new business, when there's subsidy, everything will change, right? So you have to use a different discount rate because there's a subsidized loan, the experience of issue cost. So since you are calculating APV, you have to discount using cost of equity of an ungeared company, right? And this company, Say Baba Limited, is geared. There's debt there. They need debt element. So you have to go and pick a company that is doing similar business. Even if they have debt, you strip out the debt element. They told you that Tinubu PLC, which is the proxy company, their cost of equity is what? 14%, right? Then they said, and it pays tax at 28%. Okay? They now said Tinubu PLC has 15 million shares in issue, trading at, they are giving you the share value. And they told you that they also have 40 million bonds trading at 94.88 per 100. That is the time that they have debt. So it means that this cost of equity is not KO. is not of an ungeared company. It's keg. It has geared. Because geared company means a company that has debt. So we need cost of equity of ungeared. So this is not a suitable. Don't just go and pick that 14% because they didn't give you KO. They gave you keg. They didn't give you cost of equity of ungeared. That one is still unknown, and you need it for the proxy company, right? So now, how do you get it? They said that their risk-free rate is 4.5% and the risk premium is 4%. You see, when they said the risk premium is 4%, it's like they are giving you this indication of capping approach, right? Because why are they giving us premium? Why are they giving us risk-free rate? Remember the capping approach, right? That says cost of equity is equal to your risk-free rate plus risk premium, right? Remember this formula. So if we have this as 14%, what is our risk-free rate? They gave it to us as what? 4.5%, right? Plus, did they give us this better? They didn't give us. So this is a good place to start, right? They gave us this minus this, which is market premium. They gave it to us as what? 4%. Okay. So this is the only unknown. This is the risk of a geared company. That this is a finance risk. This is not a business risk. So if we want to get the cost of equity of an ungeared company, we will need to ungear this one, this BE when it comes. So let's get what this BE is from this equation. Should I clean? I don't want to clean. Let me just clean one line. Let me just clean one line, right? So if you solve this, you have what? 14% minus 4.5% is equal to 4% BE, right? So 14% 14 minus 4.5, that's 9.5. So you divide both sides by 4%, divided by 4%, that's 2.375. So it means your BE is equal to 2.375. This is the finance risk. This is a risk associated with a company financed by debt. Maybe if I get the risk associated with a company not financed by debt, I can now put it back into this equation to get cost of equity of a company not financed by debt. It makes sense. So to get the business risk from a finance risk, remember, we've done this thing before. I'm just explaining again. You ungear, right? So now, as I said, what is the formula to ungear? That's why they gave you all these value of debt, value of equity. Because when we think that what do you need it for? That's why it is given. Okay? Even with this information given, you can still use the M&M approach straight from here. You can still use that M&M approach to get your KO. Remember that formula I gave you in the beginning of the class that what? Cost of equity of a geared company is equal to cost of equity of an ungeared company plus cost of equity of an ungeared company. Remember that formula. You can solve it straight away from there. But my normal instinct that came to me at first is that if these people are giving me the capping variables, they are indicating. When I read this, not that I was saying was the capping approach. I wrote out the capping approach. So it started guiding me gradually, right? So let's ungear. Let me not clean. Let me just carefully ungear here. I don't know if you guys can see it. So to ungear, remember the formula to ungear is what? BA. Because when you are trying to ungear, you are trying to get BA now. So that's BA equals BE multiplied by what? Multiplied by what? E over E plus D. Can you remember this formula? Plus BD multiplied by D over E. We don't have BD, right? So BD is 0. So don't need to write this part. It's slash it out. So you are trying to ungear. You are trying to get business risk, which is what we even need. Equals to what? BE, you have it to be what? 2.375 multiplied by E, the value of equity of the proxy company. See, they told you that Tinubu PLC has 15 million shares in issue, trading at $2.53 each. So you're not going to go and calculate what is the value of equity. Why didn't they just give us the value of equity like straight away? They have to start telling you that they have 15 million shares trading at. So what you do is say 15 million multiplied by 2.53, right? 15 million times 2.53. So that will give you 37.95 million. Okay? 37.95 million over value of equity, 37.95 million plus value of debt. They said they have 40 million bonds. trading at $94.88 per 100. So what you need to do is to say 94.88 divided by 100, that's per 100, multiplied by the total 40 million. Do you understand? That's what it is trading at in the market. That's what they are trying to say. So 40 million. So that will give you 37.952. That's 37,952,000. Okay. So you have, space is not enough, plus 37.952. So this their cost of equity, their capital ratio is like 50-50 into 1 minus T. And the tax rate is what? For proxy company, they are using proxy details, is 28%. So that's 0.28. Can you guys see this thing? Maybe I will zoom it in. So when you put all of this in your calculator, basically when you degear this, you are trying to degear this 2.375, right? So when you degear it, you get your BA be 1.38. This is the business risk. We don't have any business with the business risk or the debt structure of the company, so we have our 1.38, right? So since we have 1.38, we will now use this 1.38 in that CAPM formula. Let me clean off this part. So you state the CAPM formula, right? Cost of equity equals your risk-free rate plus your risked premium, right? So you know, at this point now, what you are looking for is your cost of equity of an ungeared company. You don't need that 14%. So that is the unknown. You have your risk-free rate. It always remains to be what? Risk-free rate is 4.5%, right? Plus, you have gotten your risk associated with an ungeared company. So you have 1.38 into, what is your premium? Your premium is 4%. Okay, so when you do this, put this in your calculator, you have your KO, which is what you are looking for to discount. See what you have to do. Put it in your calculator. You have 4.5 plus 1.38 multiplied by 4. That will give you 10.02%. That's like 10%, right? So you are discounting at what? 10%. Clean off all this rubbish and just discount. This one is in your working notes. This discount, can you see? This is your discount factor is what? Working 7, right? So you show it in your working note because you have to show it. If not, how did you get your 10%? You can't use the 14% they gave you. You can't use the 8% that the company normally uses. So you have to actually work this one out. And this one that you worked out can be like 2 marks. So it's very important to show it in your workings, right? Those are the little twists in the question to waste somebody's time. So 10%, yeah, that way you're using to discount. And that when you're discounting at 10%, you already know that one. That in year 0 is what? 1.000. In year 1, 0.909, 0.8, is it 826? 0.751, 0.683. Yes. So after you get your discount factor, you get your present values. That is net cash flow multiplied by this. For year 0, you still have your 14,488. You multiply this by this, multiply this by this, this by this, this by this. Those will give you your present values. And what you now need to do after getting your present values is to add, that is set them off. Get your net present value. Net present value. This one is not just net present value, it is base case, because you discounted using 10%. So base case MPV. That's the first step in getting your APV before you go to present value of financing effect, right? So when you set off all of this, let's put it in our calculator. You have 706, right? 706. That's 706,000 because you abbreviated. So you have a positive base case MPV. So you take that base case MPV to your format. So we can now clean here because we don't need this place. It's inside your note already. Okay. So you know what we are going to do. Let's just put our format by the side. We have our base case MPV here. Base case MPV. So you have it to be what? 706. Present value of financing effect. Your present value of issue costs. Present value of tax savings. Present value of subsidy. Right? So we've done this one, workings 1. Now let's go to workings 8. Right? This one is just, all this workings just for you to be able to refer the examiner to something. So in the question, they said issue costs are 4% of the gross finance required. 4% of gross finance required. Gross finance required means what? Let's just say total finance required, right? Total finance required. Now ask yourself, what is the finance required? They need 11 million, right? They need 11 million, plus they need 3 million, plus they need working capital of what? 488,000. So so 488,000 will be 0.488 million. I don't want to put everything in millions. So basically, the total funds they need for this project is what? 14,488 million. See it here now. That's what they need, right? So what you're going to say is what? 4% over 100% minus 4% times 14,488 million. Sorry, 14,488 million, right? That makes sense. So this 4% over 100 minus 4%, of course, that means 4% divided by 96%. Okay, so it means that when you say 4% divided by 96%, it means that this issue cost was actually raised with the total finance. Do you understand? This is what they need. This is the money they need for the project. But there was a particular amount that was raised. That total amount that was raised is what we call 100%. This one is the 96% portion. This one is the 96% portion. The 4% portion is the issue cost. So it means that the issue cost was raised together with total amount. It means the total amount raised was like 15 million something. When we solve it, you'll see it. So let's put this one in calculator to get our issue cost. Here's my calculator. 4 divided by 96 multiplied by 14,488 million. That gives us issue cost of what? Issue cost is what? I'm going to be writing naira. Issue cost of what? 603,666. Right? 0.6, that's 667. So this is the issue cost. It means that what was actually raised, the total finance raised was 14,488 plus 603. If you add 14 million to this, 14,488,000, that will give you the total finance raised was what? 15,091,667. Right? If you do 4% of this, if you now do 4% divided by 100% multiplied by this, you get 603,667. Okay, can you see? 603,667. You can see that if I gave the total finance raised all together, like this is the total amount that was raised, it now asks to calculate. It now tell you that issue cost is 4% of the total amount raised. That is, the issue cost was raised together with it. All you just need to do is to say 4%. 4%. That is 4 divided by 100 multiplied by that total amount raised. But since it was raised with that, you only know amount required. You always say 4% over 100 minus that's issue cost. You understand? So you always deduct issue cost from it, depending on the way they give you the information. Do you understand? So this is what we are looking for. This issue cost, because you are trying to get present value of issue cost. So you've gotten issue cost. Now get the present value. It's very simple. This issue cost is always incurred in year 0 now. You can't incur it in year 1 because the money is this is what you are trying to raise. You are trying to raise this money. So the money you need it at the beginning of the project, year 0. So if you are trying to get the present value of issue cost, you need to multiply by a discount factor, right? Discount factor at 2%. And for something in year 0, it's going to be 1.000. That will be the discount factor. Does it make sense? So you still have your 603,667. Okay. Now I told you in the last class that sometimes this issue costs, right? You might have to do net tax. You might have to do post tax because they might tell you that issue cost is tax deductible. Take note of this. In this question, they didn't say anything about issue cost. Whenever they are silent about it, you assume that issue cost is tax deductible. because all they give us here is that issue cost is 4% of the gross finance required. They didn't tell us whether it is tax deductible or not, right? So since this question has tax rate, assume that your issue cost is tax deductible. And if something is tax deductible, it says that there's going to be a tax savings on it. So remove the tax savings. That is, you're going to do that thing post-tax, right? So it means that this 603,667 will be multiplied by 1 minus t. That is 1 minus 25%, 0.25. Put it in your calculator. That is times 0.75. That will give you 452,750, right? 452,750. If they told you in the question that it is not tax deductible, don't do post-tax of it. So this one now, you take it here. You've gotten it. Your working is 8. You take it here. 452,750. So it will come in here as what? 453, right? 453. Know that issue cost is an outflow effect, so it will go out, right? Then you now go to your present value of tax savings. So let's go and do that one in our what? Workings 9. Even me, I'm tired. But if you are doing it in the exam, you should not take this long. It's because I'm explaining, and I'm always going over things too much, if I think. So let's do workings 9, which is our present value of tax shield on interest, right? First thing is to get your interest, right? Get your interest. How much is your interest? How much are you paying annually as interest to service this loan? First of all, ask yourself, how much is the loan that was raised? What is the loan amount? How much is the loan that was raised? What is the loan amount? Why is the marker not working? I just changed. This is the amount required, but this was not the total amount raised. Remember I showed you that the total amount raised is like 15 million something, right? So they raised this amount, and they also raised the issue cost, right? So that's 14,888 plus the issue cost. We got the issue cost to be something, not the PV, the issue cost itself. This one is just the present value. You have discounted. That's what it means. The issue cost itself that we raised was, I think, 653. 14,488. Let's calculate that. 14,488 plus 603, right? That was what we got to be the interest. So 14,488 plus 603. So that's 15,091. We've actually calculated that before. So this is the loan amount, right? This was the total amount raised. So if this is the loan amount, what is the interest? How were they servicing it? You know, in the question, they said that the government liked this project and they want to give a loan. They want to give a subsidized loan of up to 80% of the investment funds required. So if government takes 80% of this, right, it means the remaining 20% was probably sourced from somewhere else. Okay? The reason why I'm breaking down is because the rate, you know, we're trying to get interest rate. The interest rate of a subsidized loan is different from the interest rate of the normal loan, right? So 80% of this 15,091, let's calculate it, is what? 12,073. So 12,073. Then the remaining one, the 20% is what? 3,018, right? So if you add these two together, you get it. So government took up this loan. They decided to give this Sebaba Limited this loan. They sourced this one from normal market loan. So government is giving them at what interest rate? Because it's not the same interest rate. That's why we're trying to get the annual interest. How much is paid annually? When we get it, that's when we can calculate tax savings on that interest. Then we can now get the present value. Does it make sense? So the interest rate for government loan, what did they say in the question? They said that Nigeria's government has been positive about the venture and has offered Sebaba Limited a subsidized loan of up to 80% of the investment at a rate of, that's at an interest rate of what? 200 basis points below Sebaba's Limited normal borrowing rate. This is normal loan. Remember when I was giving that subsidy formula, we've not even got into subsidy yet. Okay, so now said currently Sebaba can borrow at, that is what is the normal rate, can borrow at what? 300 basis points, 300 basis points above, that is plus the normal 5-year government debt yield rate. And they say somewhere in the question that the government, that's at the end, the government debt yield rate, which is the risk-free rate, is 4.5%. So you just add it towards 4.5%. I remember I told you when we were doing cost of debt class that when we've done all this, that whenever it's something like 300 basis points, it means what? 3%. I'm not going to explain this one because I've already said it before. So when you add this together, you have 7.5%. It means this is the normal rate for this normal loan, 7.5%. Now, what is the government rate? He said government will give this loan at a rate of 200 basis points below Say Baba's limited normal rate. So 200 basis points below means what? Minus 2%. Remove 2%, so it means that it's at what? 5.5%. Look at all the drama just to get interest rate. Because I'm trying to explain, I'm thinking like I'm maybe probably over explaining it, but it means that this 80% loan, government loan, the interest rate is what? 5.5%. It's obvious that it's subsidized, while the normal is given at what? 7.5%. So that makes sense. That's why I was writing all of this. So since we have gotten the interest rate now, it means we can now get the interest amount. So interest, total interest, now is divided into what? Government and normal, right? So government loan will be what? 5.5% of how much they give us as loan. Normal will be what? 7.5% of how much they give us as loan. So how much government give us as loan? What we just calculated now, 0.18, right? So we get our interest rate. So the government interest will be equal to 5.5% of this, $664, and then the normal, this times this, that will give you $226. Do you understand? So this is the total interest. When you add it together, let's add it together. You have $890. So this $890,000 is the total interest we paid annually, year 1 to year 4, right? Because you pay interest annually, you service it to the end of the project, right? So we have $890. We have to separate it first because they have different reasons. We now finally added it together. Okay. So now, since you've gotten the interest, you now try and get the tax savings on the interest. And how do you get tax savings on interest? You multiply by the annual tax rate. Okay. And the annual tax rate is 25%. So you say times 25%. So when you put this in your calculator, you have 222.5. That's what? $223,000. That's your interest. That's your tax savings on interest. This is your interest. This will happen in year 1, year 2, year 3, year 4. Okay. Now, since this will happen in year 1, year 2, year 3, and year 4, what you need to do is to get the present value of the tax savings. Right? This is constant cash flows. So you need to get the present value of that tax savings. Right? So you multiply by a particular cumulative discount factor. Right? So you multiply by discount factor, cumulative discount factor, at how many percent? Now, don't forget that this is interest. So you're not going to discount at maybe cost of equity. You're going to discount at the cost of debt. So you're going to pick the normal cost of debt, which is what? 7.5%. Pick the normal when you are trying to discount, okay, for debt interest. You know, everything you are doing here relates to debt. This interest relates to debt. So you are discounting at what? 7.5%, right? So let me just clean up all these ones. So we have $223,000 multiplied by cumulative discount factor at 7.5% for 4 years. Does it make sense? So instead of it to be saying in year 1 223 and the discount factor multiplied by year 1 223 multiplied by year 2, you just do your cumulative discount factor, right? So this one now, you will check your annuity table. When you check your annuity table, you won't see anything like 7.5% under year 4. What you see is 1%, 2%. I'll put it on the screen. 3%, 4%, 5%, 6%. You don't see anything in points. So what you do is that you will check 7% under 4 years. Then you will check 8% under 4 years. You will add those 3 point something and 3 point something together and you will divide by 2 to get it at 7.5, right? You're trying to, that's the way to do it. You're trying to find the balance. So because me, I don't even have time to do all this, I'm just going to use that cumulative discount factor formula, which is 1 minus 1 plus r raised to power minus n over r. Okay, so 1 minus 1 plus r is what, 0.075 raised to power minus n. N is number of years, minus 4 over r, 0.075. If I put this in my calculator, I'll get 3.349 as my cumulative discount factor. That will multiply by $223,000 to get what I'm looking for, which is present value of tax savings on interest. If I multiply this by this, 223 times 3.349, I'll have my present value to be 746.8. That's 747. Okay, so you bring it here as what? 747. Tax savings is an inflow effect, so you have 747. This is, if you don't know this formula, use your annuity table in exam, but it's just like you won't see 7.5% under your annuity table, right? And you cannot abbreviate because you didn't solve this, it was directly given through basis points. If you check 7% under year 4, you have like 3.387. If you check 8% under year 4, you have like 3.312. Now, because it's 7% and 8%, you add it together and divide by 2, you get 3.349. But this formula is a cumulative discount factor formula that just takes you faster, right? Instead of checking an annuity table. But annuity table is accurate. That's why I suggest that you just check the annuity table, right? So if in year 1 you have 223,000, year 2, year 3, year 4, you have the same thing. By the end of the year, by the end of 4 years, you have something like 8, right? But because you have discounted, when you discount something, it reduces to present value, it reduces the value. That's why you don't have 8 something, you have 7 something. Because you should be looking at it that what this discount factor does, this cumulative discount factor does, is that it has put the 4 years together. It has cumulated everything together. Okay, so you can try to do your own year 1 multiplied by discount factor year 2 is your time. Sure you understand? Now let's go to present value of subsidy, and we are done with the A part of the question. The B part of the question is very simple, something that I've even been answering it in the question. It's just a note part and it's 8 marks, something that can even bail you out if you understand the concept. Some people just feel like, no, just solve questions, solve questions. If you don't understand the basic concept, you won't understand when they are solving, right? That's why you don't understand the past questions you are reading sometimes, because there are some assumptions that, and that's what the B part is asking you to do. The B part is asking you to discuss the appropriateness of the evaluation method. Appropriateness means, why are you using MPV method? Right? And is that steer I gave you in the first class because there's presence of subsidy? You will explain it. We'll go there, right? So present value of subsidy, you go and calculate that. That will be your workings 10. Wow, this is really ICAN. ICAN is nobody's mate. So you have your workings 10, right? And that is present value of subsidy, of which I gave you the formula, right? I gave you the formula in the previous class that you say the subsidy amount, the loan subsidy amount, right, post-tax, multiplied by normal rate minus subsidy rate, multiplied by your discount factor. Does it make sense? Now, your loan subsidy amount, that is the subsidized loan, is how much? You know, it's just 80%. That's what we calculated. Is that we calculated as 12,073,000, right? Multiplied by, what is your normal rate? 7.5% minus your subsidy rate 5.5% times your cumulative discount factor 3.349 that we got earlier. And I told you this must be post-tax, right? Minus 1 minus 0.25. So let me explain the subsidy, loan subsidy again. You know, if you are getting, okay, if you pay your loan, right? If you get your loan at a normal rate, at this normal rate of 7.5%, this 7.5%, you know, it means your interest to be higher, right? So because your interest is higher, it means your tax savings is higher. So for getting a normal loan, the assumption, which is something that is reasonable, is that you have forfeited a higher tax savings, although you got a subsidized loan, right? You got a cheaper loan rate. So that interest difference, because these are the interest rates, that interest rate difference, what is the difference upon the loan? Then you multiply by what? Your discount factors. Should I explain in Yoruba? Do you understand? You multiply by your cumulative discount factor for year 1 to year 4, as long as you're going to keep paying that interest. Although you are forfeiting a higher tax savings that would have been gotten on this. That is why they brought in 1 minus 0.25 here. You don't need to understand. I'm just explaining this concept because it can help you to remember. Sometimes you forget formula, but just learn the formula. And the formula is easy, right? Let me write it because I've already scattered it. The formula is very easy. Sorry, I'm dragging it though. Loan subsidy or subsidized loan post-tax times your normal rate minus your subsidy rate times your cumulative discount factor. That's all. And our loan amount is what? 12,073 into 1 minus 0.25, right? Multiplied by our normal rate 7.5% minus our subsidy rate 5.5% times cumulative discount factor 3 times 349. You put all this inside your calculator, that will give you $607,000, right? So you just bring that here to what? 607, and then we are done. We are done with 17 marks. Really? So you cast this, right? You say 706 minus 453 plus 747 plus 607, and that will give you 1607, right? That's $1,607,000. So when they said you should evaluate the appropriateness, so how did they put it in the question? Yeah, that you should evaluate on financial grounds. This is on financial grounds. They have brought in financial figures. Whether Sebaba Limited should proceed. Yes, Sebaba Limited should proceed with the investment in project mobility vehicle. Why? Based on the computation above, or based on the computation in the appendix, or however you solve your question, the project shows a positive adjusted present value of $1,607,000. Since it is positive, Sebaba Limited can proceed with the project. That note you wrote can give you like 3 marks or 2 marks, right? So all this, everything will add up to the 17 marks. Then B part of the question says discuss the appropriateness of the evaluation method used and explain any assumptions made in part A above. That is when you were solving, did you make any assumptions? We made many assumptions. I can't even see everything. There might be some that I see that you did not see, or there might be some that you are seeing and I'm solving and me I cannot even see. But when you said discuss the appropriateness, that one is like 4 marks. Then discuss any assumption, express any assumption, that's another like 4 marks. So in case you are thinking how should I answer, just put it in 4 bullet points or just give them 4 points so that you don't waste your time. The appropriateness, remember the reason for APV. Why is it why are you using APV? Because there's subsidized loan. You write it well low. The appropriateness arises from the fact that there is a presence of subsidized loan in the project being appraised by Sebaba Limited. To drink water. B, we don't have complex tax rates here, so tax is out of it, right? You talk about the presence of issue costs, right? You talk about the risk. You spread that risk into 2 because of the finance risk, right? Yeah. You talk about the finance risk. You talk about the business risk, that because they are going to do a new business, the business risk is going to change. They cannot use the existing capital. Do you understand? Now let's move to the assumptions made. The first assumption is working capital assumption that is coming to my mind. There's an assumption that working capital is introduced in the beginning of the year and recouped at the end of the year. There's also an assumption that the business risk suitable, or that is the business risk suitable, or the business risk that is existing in the proxy company is suitable for Sebaba Limited project. Do you understand? So you're going to write that also. There's also another assumption that the feasibility study, that money that is talked about at the beginning, you see, just read the question, you see many assumptions. Say feasibility study commissioned by the director at a cost of 2,000 naira has produced the following information. 2 of us, we both agreed that you and I watching this video, we agreed that we should render that cost irrelevant. So you are assuming that is an irrelevant cost. So it is assumed that the feasibility cost is, they're just telling you that you should state the assumptions that you reached, the conclusions you reached, as in the assumptions that you made in trying to solve these things. You made a lot of assumptions, right? You made a lot of assumptions. So you check within your question to see the assumptions that you made. That makes sense. You assume that you want to discount the debt at 7.5% at the normal rate. Why didn't you do it at subsidy rates? We assume that we should discount at this, right? So you write those assumptions. There are many assumptions there, but the important ones are what I've already listed there. So that's the end of this class. Thank you guys so much for watching. In our next class, there's no example on APV again. I believe that with this you already understand APV. Just be able to state your formula, be able to write down something. I pray that God will grant all of us success in Jesus' name. So the next class, we're going to move to international investment appraisal. And from there, we'll move to options, real options, and options pricing. Then we'll be done with investment appraisal. I think then we move to specific investment decisions. Then from there, we can go to corporate valuation. That's all those business valuation. Then from there, we can move to mergers and acquisition and other topics as we can cover as God gives us grace, right? Thank you so much for watching this video. Please give it a thumbs up and share it with anybody that you know that will find it helpful. And I'll see you in the next class. Bye.